Hello and welcome to Portfolio Matters Weekly Markets Checklist Week 157. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware we'll be discussing securities we own or have financial interest in. Please do your own research, consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a few housekeeping items. This Wednesday on the Discord, we will be having another chat with Rogue Trader. He will be discussing money. So I hope to see a few of you there. Now, I'm afraid you only have me again this week. Richard is having his boat put back in the water. I hope he hasn't added too many gold fittings. Okay, news this week. This morning we had UK GDP data, and that was unexpectedly strong, coming in at 0.6% in Q1. Now, reminder, the IMF had downgraded UK's growth forecast for the whole of 2024 to 0.5%. So unless the UK economy turns back down, I think they're looking a bit silly. Strength was broad across services and manufacturing, but it was driven by trade. We will take you through the numbers. We also had the Bank of England MPC meeting this week, and they left interest rates unchanged at 5.25%. The change was that 2 of the MPC members voted for a cut, up from 1 last meeting. And Andrew Bailey, the Bank of England governor, signaled that if they got further good news on inflation, then the market could expect rate cuts this summer. The Bank of England revised down its inflation forecasts and now expects UK inflation to hit the 2% target in Q2 before rising again later in the year. Again, we'll show you the chart. The Swedish Riksbank also met and cut interest rates by 25 basis points to 3.75%. The global rate cutting cycle has begun. Last Friday, after we recorded PM, the US non-farm payrolls came out and they came in soft. Now, everything has rallied on the back of that, on the prospect of lower interest rates. Is the US economy finally showing signs of slowing? Some charts related to news. Well, this is UK interest rates. They remain at their highest level we've seen in 15 years. And this is the Bank of England's inflation forecast. You can see that they're expecting inflation to hit the 2% target in the coming months, then bounce, but fade towards the 2% target medium term. So in 2025, they're expecting UK inflation to be in the high 2s before fading in 2026. This is Swedish interest rate. They've cut first time this cycle. And the number of central banks whose last rate move was a rate cut is rising. Now, following the soft US jobs report last Friday, the market is pricing in more rate cuts than it was, but marginally. So prior to the non-farm payrolls, it was pricing in 1 rate cut this year. Now it's pricing in just under 2. So market still expects US monetary policy to remain tight. And finally, onto the UK. Now, this is the forecast for the number of seats each political party would get based on current polling. And on current polling, Labour would get an absolutely monster majority, which would be incredibly bad for the country, frankly. Whenever any party dominates Parliament, they can get through anything they like. And that leads to poor policy, both when the Conservatives dominate Parliament and when Labour dominates Parliament. Sensible policy generally occurs when there's a balance and each side has to rely on getting their marginal MPs to agree to the bill. So they have to be sensible. Reminder, Labour plans to increase the UK energy windfall tax from 75 to 78% and prolong it to 2029. If they do that, the North Sea basically stops being drilled. Okay, on to this week's economic data. So, latest data shows the UK economy remains weak, and we should show you the data, but it is strengthening and definitely appears to have bottomed. The EU remains weak, but again appears to have bottomed. The US is strong, but there are some signs that the rate of growth is slowing. The jobs market is slowing. The GDP data, not yet. China, very difficult to tell. Global manufacturing shows definite signs of an upturn. Okay, on to the UK. So this morning we had UK quarter-on-quarter growth data for Q1, and that came in at much better at 0.6%. UK returning to growth after 2 quarters of contraction, so we are out of a technical recession. And if we look at the causes of the strong quarter, well, services growth was generally strong, although the ONS is saying a large part of services was due to growth of 6.4% in land transport services via pipelines, excluding rail transport, whatever that is. And that rate of growth presumably is not sustainable and looks more like a one-off rise. But you'll see very broad growth, almost all sectors expanding. The only one to contract is accommodation and food services, so that is the weak UK consumer. Manufacturing also showed strong growth, particularly in transport equipment, which I take it to mean the car industry, but you'll see the growth was much less broad than in services. But then when we look at the components of GDP growth in Q1, well, it's been driven by trade. So once again, it seems that the big US trade deficit is supporting growth around the world. So year on year, the UK economy returned to growth in Q1. That's great news. And turning to the month-on-month numbers, March, 0.4%. So we've had 3 months of strong GDP growth. If this continues, then the UK economy could grow strongly this year. Reminder that the IMF is forecasting the UK GDP at only 0.5% for the entire year. And in Q1, we have already had growth of 0.9% according to the monthly numbers. Year on year, GDP growth is 0.7%. But before we all get a bit too excited about UK GDP, this is its medium-term performance and really not very good. It's only GDP per capita in the UK is only up 4% since 2016, and the US is up 15%. Italy is up 11%, although, as we've talked about many times, that's because Italy is coming from a very low base. Japan is up 7%. France is up 6%. The UK is in line with Germany and doing better than Canada. Canada's doing very poorly. UK industrial production beat expectations at 0.2%. in March, down from very strong numbers in February, but well above expectations. And that meant year on year also beat expectations, though down on February. Manufacturing production was good in March, much better than expectations, though worse than February at 0.3%. And year on year, it came in at plus 0.7%, again beating expectations and up on February. Construction orders, though, were poor. Construction orders in Q1 were expected to rise by 13% after falling by 30% in Q4. Instead, they continued to fall, down a further 3%. However, when you look at the chart, it definitely appears construction orders are bottoming, although obviously from a low base, having fallen 30% in Q4. Construction output in Q1 was down 2.2%, which was worse than expectations. So the construction industry is definitely suffering from higher interest rates in the UK, but manufacturing and services appear to have bottomed. Now, retail sales for April were truly abysmal. The data we've shown you on UK GDP all is for the first quarter and the period to March. April retail sales were terrible, down 4.4% year on year. And given the March number was 3.2% year on year, it suggests month on month retail sales were extremely poor. So I'm going to read this out. Retail sales in the UK dropped by 4.4% on a like-for-like basis in April 2024 from a year ago, defying expectations of 1.6% growth as consumption was hit by wet weather and the early timing of Easter. The latest figure also reversed sharply from the 3.2% gain in March and was the worst reading since November 2019. Persistent inflationary pressures and high borrowing costs have contributed to weaker spending. Helen Dickinson, the chief executive of the British Retail Consortium, said dismal weather and disappointing sales led to a depressing start to spring for retailers, even accounting for the change in timing of Easter. A dull, wet April dampened sales growth for clothing and footwear, especially outdoor sportswear, as well as DIY and garden furniture. Halifax house prices were disappointing, up 0.1% in April, below expectations, but up on March. And year on year, up only 1.1%, although that was better than expectations. As we discussed last week, UK houses are incredibly unaffordable, but prices are not dropping. The Royal Institute of Chartered Surveyors house price balance remained steady at -5 last month. New car registrations were incredibly disappointing, actually, coming in at only 1% year on year, well down on expectations and massively below March. So it seems that UK consumers really cut spending in April. Maybe that was just due to the bad weather. We shall see. The UK Global Construction PMI, though, for April ticked up. Now, we know that construction has actually had a terrible year. So there seems to be very little connection between the PMI and the performance of the construction industry over the past year, but it is picking up, and that's good news. So perhaps the construction cycle has bottomed. What is driving that is commercial and civil engineering, which seem to have returned strongly to growth. The housing sector remains weak. And Savills, the property consultancy, are forecasting that the pace of new house building will fall further in the coming years. So home construction does not look like it's going to be recovering anytime soon. The UK Citigroup Economic Surprise Index ticked back up to 9.9. UK economy surprising to the upside. Today's figures will add to that. The Indeed job postings index was at 103. Is that the decline is definitely slowing? Now, Indeed have revised their UK, German, and French data. So we can't really compare it with the last time we reported. But I think you can say that the shape of this curve is definitely flattening. The fall in UK jobs posting appeared to be slowing, further evidence of the economy bottoming. UK trueflation fell slightly to 3.02% this week from last week, still way above the Bank of England's 2% target. Now next week, I'll be doing a long segment on the causes of the inflation we have experienced over the last few years, after a viewer, Mr. C. Peckham, got in touch once again to correct me. And his point is that the sole cause of the inflationary episode was supply shocks. Now, these charts show UK domestic consumption, and you can see that although the value of goods consumed in the UK has risen, the volume has actually fallen pre-pandemic. So the inflation was absolutely not caused by demand shock. If there was demand shock, volumes would have risen. They've fallen. What's happened is a supply shock and the aftermath. More on that next week. But if we go through this, you'll see UK consumers, although they're spending much more on food and non-alcoholic beverages, their consumption has dropped really quite markedly. UK consumers are not having a good time. They've also cut their expenditure on clothing. Housing is particularly bad. So big increases in rents and mortgage costs. Their expenditure on furnishings and maintenance, which shot up during the pandemic when people were spending more time at home, has also collapsed and is now below pre-pandemic levels. Healthcare spending flat. Communication, well, one of the big changes during the pandemic was that everyone started subscribing to Netflix and online subscription TV channels, and that has continued. That is the one area where UK consumers appear to have increased their consumption. Recreation and culture, again, that's a big drop, 5% lower volume. Education, I'm puzzled by this. So the value shot up, but so has consumption. If anyone knows what's going on in UK education, please get in touch. Restaurants and hotels. Actually, I thought this would have risen after lockdown quite strongly. It hasn't. People have been put off by rising prices and have cut down on their consumption. All that leads to the UK consumer having a bad time. They have definitely experienced a supply shock. So their consumption is below pre-pandemic levels. And the contrast is very much with the US, where consumption has resumed its previous path, leaving UK consumers in real terms much worse off than either the EU and the US. UK consumers are consuming less than they did pre-pandemic. But the good news is UK small businesses are increasingly optimistic and the cycle appears to have bottomed. So in summary, Q1 GDP for the UK came in very strong at plus 0.6%, driven by services and trade. Domestic demand was still weak. But Data for April was poor. UK retail sales were very poor. Car sales were very poor. The construction industry also appears to be bottoming, though it remains weak. Bottom line, the UK economy actually is surprisingly strong and definitely appears to have bottomed, although let's see what the April numbers are given the poor retail sales. Okay, and on to the EU. The EU unemployment rate remained at its lows of 6.5%. Retail sales for March were surprisingly strong at plus 0.8%, beating expectations and reversing the decline in February. And that decline was revised down. So only minus 0.3% in February compared to initial estimate of minus 0.5%. Year on year, that means EU retail sales rose 0.7%, much better than expectations, and positive once again. The construction PMI in the Eurozone is awful, down to 41.9, pretty much the lows for the cycle, and missing expectations of a gain. The good news was producer price inflation month on month in March was minus 0.4%, slightly worse than expectations, but still negative. And that's year on year. It came in line with expectations at minus 7.8%. So input prices in the EU are still falling. That's really good news for the fight against inflation. The Citigroup Economic Surprise Index is still decently positive, although less positive than it was. Now, the jobs postings indices in the EU, this is Germany, still fading. But again, can you say the rate of decline is slowing? France, very strong compared to pre-pandemic, but again, fading. So in the EU, not much data this week. Retail sales for March were much stronger than expected. Construction activity continues to weaken. The good news was producer price inflation remained negative in March. So the EU economy is weak, but appears to be bottoming. And there's little evidence of inflationary pressures. In the US, we had non-farm payrolls for April and out last Friday after we'd recorded the weekly, and they came in weaker than expected at 175,000, below expectation of 243,000. Now, we have been talking for a while now about falling job openings and a weakening jobs market, and the jobs report provided lots of evidence of that. So hourly earnings month on month came in at 0.2%, worse than expected, good for inflation though, and year on year at 3.9%, still high but falling. Hours worked ticked back down to 34.3, and that is a poor number. Participation rate was flat. Government payrolls. Is the surge in government payrolls finally coming to an end? Up only 8K compared to expectations of 63K. Private payrolls, actually that's a decent number, below expectations but still strong. The unemployment rate ticked up to 3.9%. The U6 unemployment rate, which includes discouraged workers, rose to 7.4%. Steadily ticking up. Now, the unemployment rate at 3.9% remains incredibly low by historic standards, but it is ticking up. It's up 0.5% over the past year. And the vast majority of new jobs created in the US have gone to immigrants. So the blue line is employment of people not born in the US, and the orange line is people born in the US. Since the pandemic, there has been a lot of retirement of people, of baby boomers born in the US. But although jobs growth was weak, it was pretty broad. So this is a diffusion index of private sector hiring, and it remains above 50. So the majority of industries are adding jobs. But although the US has returned to jobs growth much stronger than any other country, it has not regained its pre-pandemic trend. And the household survey shows a similar pattern but worse. You'll note that the household survey is showing that the number of people employed peaked last year and has since been falling. And all the jobs created in the past year, according to the household survey, have been part-time jobs. The number of full-time jobs did tick up slightly in April. So this is jobs growth of the past year, according to the household survey. It's all been part-time. There's been actually a net fall in full-time employment. The good news is prime working age participation in the US has ticked up and is now higher than pre-pandemic. So strong jobs market is pulling in working age people. Non-farm payrolls, year on year, the growth is 1.8%, and that is the lowest post-pandemic. So the US jobs market remains strong, but evidence it is slowing. And when you look at US small businesses and the National Federation of Independent Businesses, their hiring plans, which is the gray line, well, they're very poor. And the 1 month change in private payrolls, well, if you believe the lag, the 3 month lag, then that should continue to fall in the coming months. We also had ISM services. That was very weak, actually, surprisingly weak, returning to contraction. 49.4 expected to strengthen to 52. Business activity fell quite sharply to 50.9. New orders fell as well to 50.2. ISM employment index fell pretty much to new lows for this cycle at 45.9. The numbers are volatile, but that's not a good number. Prices paid, though, ticked up to 59.2. So the ISM services, not reassuring. It seemed to show stagflation. So services activity falling, but prices paid rising. Reminder that there appears to be very little or no link between the PMIs and actual economic activity. Consumer credit for March was weak at 6.3 billion, lower than expectations. US consumer confidence, as measured by the Real Clear Markets TIPP Economic Optimism Index, fell sharply to 41.8, not a good number. Used car prices continue to fall, down 14% in the year to April. Good news for the fight against inflation. The Logistics Managers Index fell sharply to 52.9. Vehicle sales actually held up decently well at 15.7 million annualized in April, up on March. So having reported weak non-farm payrolls and weak consumer credit, well, the Johnson Redbook retail sales rose to 6% year on year. So there's not much evidence of a slowdown in US consumer spending. The 30-year mortgage rate remains very high, but down. Mortgage purchase index. So I've changed this. Previously, we were looking at the mortgage activity index. This is just mortgages taken out for purchasing new homes. And you'll see that it is very low, but up on last week. Initial jobless claims spiked to 231K, but that looks to be idiosyncratic. Initial jobless claims also rose a bit. Now, The cause of the spike in initial jobless claims appears to just be New York. Some funny things going on there. It looks like seasonal adjustments. So that looks like a one-off and not the start of a new trend. But if you look at continuing claims and don't use the seasonal adjustments, instead you just look at the pre-COVID average and you're looking top right, the chart top right, you can see continuing claims are rising compared to the pre-COVID trend. So further evidence that the US economy, the US jobs market is slowing. And the SARM rule, therefore, is ticking up. Reminder, the SARM rule signals a recession when the 3-month moving average of the national unemployment rate rises by 0.5% or 0.5% or more relative to its minimum over the previous 12 months. So ticking up slightly, not quickly. Turning to the live GDP estimates, well, Dallas Fed, actually, that is not a new data point. That's still the 27th of April and still 2%. But the Atlanta Fed GDP now shot up to 4.2%, and all components were strong. So the Atlanta Fed thinks the US economy is doing just fine right now. But the Citigroup Economic Surprise Index surprised to the downside, falling into negative territory last week. Indeed, job postings continue to fall. Trueflation flat at 2.3%, so close to the Fed's 2% target. Lightcast, which is another job postings aggregator site, reported a 4% fall in job postings in the US last month. And as you can see, those falls were pretty broad and down 22% year on year. So further evidence that the US jobs market appears to be slowing. So in summary, a generally weak set of data from the US this week. Non-farm payrolls missing expectations, but still rising by 175,000 jobs in April. Hourly earnings also slowing to just 0.2% month on month as work fell. Unemployment rose. The ISM services PMI fell, and the employment index fell sharply to 45.9. All evidence that the US jobs market is slowing. But Atlanta Fed's GDP now estimate for Q2 rose sharply to 4.2%. The bottom line is the US economy is strong, though there is growing evidence of labor market weakness. Will that feed through to a slowing US economy in the coming months? And on to China. Caixin Manufacturing Index, reminder that's the private sector PMI, ticked up to 51.4, so in weak expansion territory. Services fell slightly to 52.5, in line with expectations, but down on March. Composite, therefore, ticked up slightly to 52.8, better than expectations. According to the Caixin survey, the Chinese economy is doing just fine. Its balance of trade ticked back up to $73 billion. Astonishing numbers. Exports rose more than expected, up 1.5% year on year. In April, imports up 8.4% year on year. When you look at steel production in China, and these hard numbers are the sort of numbers we like because the official numbers are heavily manipulated, then you'll see steel production has been falling for quite a long time now and is evidence of a weak construction sector. And the FT had a story about the sales of, let's say, used houses in China. So historically, the Chinese economy has been propped up by new construction and sales of new flats for investment. As Chinese house prices have started falling, so those houses are coming onto the market and buyers like them because they're actually there rather than buying them off plan and being at the risk of the developer not actually finishing them. So these are house prices, and you can see already built houses are seeing a strong fall in house prices. And so that reduces the incentive to buy new apartments for investment. This is all bearish Chinese construction and therefore bearish quite a large chunk of Chinese economic growth. So China summary. Chinese imports and exports were stronger than expected. The Caixin survey remained pretty strong. Bottom line, the official data suggests the economy is doing just fine, but it's very difficult to tell. There are huge contradictions in Chinese economic policy that must eventually be resolved. Normally, some sort of financial crisis is required for that to happen. Now, in the case of China, we know that a lot of the property developers are going bust, but in a command economy, it's possible to deal with that sort of crisis without having a systemic crisis. And onto one chart. So this is the personal savings rate in the US, and you can see it is very low by historic standards, although pre-GFC it was lower than this for several years. Now, we have been saying that this low savings rate needs to revert, but US consumers rebuilt their balance sheets during the pandemic, and so they don't need to save as much as they did post GFC. And also, the fall in the savings rate could be driven by baby boomers retiring and now consuming their savings. If that is true, that means that the savings rate will stay low for a long time. But I'm slightly skeptical of that argument because I don't think there has been a huge increase in baby boomer retirement enough to make such a difference to the savings rate over the last few years. Now, on to US illegal immigration. So we showed you this chart earlier, and this is the rise in US employment post-pandemic. And you see all the jobs have gone to foreign-born workers. And since the Biden administration took office, the number of illegal immigrants crossing the Mexican border has absolutely exploded. Now, this is encounters with the US border force. So this is not illegal immigration. This is the ones they caught. But the CBO estimates that illegal immigration across the Mexican border was around 860,000 in 2023. And when you think of total job creation in 2023 was about 3 million, that is a huge chunk of the labor supply in the US. So how long does it take illegal immigrants in the US to join the labor force? Well, first of all, they need to apply for asylum, and that can take up to 6 months. There is then a minimum wait of 150 days after you've applied for asylum before you can apply for a work permit. So we're now talking the best part of a year. And the US is currently taking between 5.5 and 15 months to process work permits for approved asylum seekers. So you're talking about 18 months to 2 years before illegal immigrants in the US can actually enter legal employment. Now, all these illegal immigrants will be in the workforce, but they'll be working in the unofficial sector. So the FT had a story about a Venezuelan baker who was unable to find official work in New York and was therefore selling food on the street from a stall. So all these illegal immigrants are currently being not as productive as they will be when they get a work permit. And that should be good for US labor supply. But it will also be inflationary because all those new immigrants into the US need to buy a house, they need to buy a car, they need to buy furnishings, they need to build a new life in the US, and that will create a demand shock. Now, Bloomberg estimate there have been illegal immigration of 7 million between 2021 and 2023. Now, that number seems high. We've just seen that the CBO estimates that illegal immigration in 2023 was only 860,000. So that would suggest the true number was something of 3 million. But based on illegal immigration of 7 million, that would mean that initially you'd see a rise in US unemployment of around 0.3%, but there'll then be a rise in wage inflation of 0.1% due to excess demand, and the Fed funds rate, they have to say 50 basis points higher than otherwise for 2 years to absorb that demand shock and keep inflation lower. So the prognosis due to illegal immigration into the US is strong economic growth accompanied by inflation. And on to the US housing market. Now, the US housing market has been a total mystery. Its affordability is very poor because house prices have risen very strongly, up 20% since the pandemic. Interest rates have risen, therefore mortgages are unaffordable. And so you see the affordability threshold at 100. We're now at 75. Houses in the US are just unaffordable for the vast majority of people. But prices continue to rise, mystifyingly. They're up 4.8% year on year. The median asking price is now up 7.7% year on year. And mortgage payments on the median asking price are up 14% year on year. Ouch. But although house prices are rising, sales are falling. So pending sales down 3% year on year. Listings are rising. That means the stock of houses on the market is rising strongly. So you have more houses, fewer buyers. We have 3.4 months of supply on the market. Pending sales, it's taking longer to sell those houses. Only 44% of pending sales, i.e. those houses actually getting sold, were sold within 2 weeks. That's a low. But still, 30% of houses sold above their final list price. A rising number, though, have had price drops. So although we're seeing rising house prices in the US, a growing number are having to cut prices to get them sold. That would seem a contradiction to me. But the average home in the US sold pretty much for its asking price. The number of home buyers is falling, down 9% year on year. So in summary, the US housing market remains strong as evidenced by rising house prices, but houses are unaffordable, transaction volumes are down, buyers are down. How long can this continue, we ask ourselves, as we've been asking ourselves for the last 18 months? Okay, and on to the US Senior Loan Officers Survey for April. And this is the percentage of lenders reporting that they are still tightening lending standards, and that actually rose a touch in Q1. So net lending standards still tightening, but not fewer reportees are tightening than they were last year. Credit spreads still tightening, but again, fewer lenders reporting that they're tightening. Demand weak, and again, majority of correspondents saying that they're seeing weaker demand for commercial and industrial loans. Credit standards for real estate loans, fewer respondents tightening loan standards, and fewer reporting weakening demand. So evidence that the construction sector is bottoming. Credit standards for residential mortgages still tightening, but much more slowly, and demand falling more slowly. Consumer loans, similar pattern. Fewer lenders still tightening, but little increase in demand. Actually, more respondents reporting falling demand for consumer loans. So in summary, the credit standards continue to tighten, but fewer banks are reporting tightening lending standards and increasing their credit spreads. Demand remains weak, but there are signs that the credit cycle is approaching its bottom. And on to OPEC. So we've had OPEC production for March, and that was unchanged on February. And we're just going to run through quickly each country. So when you look at change March to Feb, well, OPEC discipline is essentially holding. You see that there's almost no change in total production between March and February. Production held steady at 26.6 million barrels. This is Algeria, which is complying with cuts. Congo, tiny rise in production. Equatorial Guinea, long-term decline. Iran, production pretty steady. It is exempt from the Iran is exempt from quotas, so production that appears to be its natural rate. Iraq is cheating, but its production has fallen slightly over the last few months. Kuwait complying with cuts. Libya flat. Nigeria actually recovered decently after the last couple of years. Saudi Arabia flat, complying with its own cuts. UAE the same. Venezuela has the growth stalled. So when we look at the quotas, actually everyone appears to be in broad compliance except for Iraq, which is producing 280,000 barrels a day more than it should, according to S&P Platts. And when we look at the non-OPEC members of OPEC Plus, well, only Kazakhstan is really cheating. Everyone else is complying with the cuts, or they're undershooting because they can't produce as much as they're allowed. So in summary, March OPEC production was stable. Iraq appears to be the only OPEC country engaged in significant cheating. OPEC production is stable because of the production quotas, and apart from Iraq, everyone's complying. Okay, on to inflation watch. So no new data this week. The Bank of England kept interest rates unchanged at 5.25%. It next meets on the 20th of June, and the year is over a third of the way through. We're expecting the Bank of England to start cutting in the summer. Now, in the US, rents are down, which is good news because shelter is a big chunk of services inflation in the US. And the vacancy rate for apartments continues to rise. That implies rents are going to remain subdued. Rental inflation will remain subdued. This is the Manheim Used Car Index. It spiked enormously during the pandemic, but is now fading. That's great news. And is it any coincidence that personal savings, excess savings, and inflation have declined in tandem? US hourly earnings, the 3-month annualized change is now at 2.8%. So wage inflation is falling, and that's exactly what you would expect from the weakening labor market. So in summary, although the monthly numbers are volatile, all the indications are that disinflation is continuing everywhere. The market currently fears that inflation will be resurgent, but falling wage inflation suggests that is unlikely. Onto recession watch. Now, there is a recession indicator in the US that has been triggered. It is the McKelvey rule, which is sort of a weaker example of the SARM rule. And it says that recession occurs when there's been a 0.3% rise in unemployment compared to the 12-month low. And it's triggered in October last year. There was no recession. It's triggered again now. Now, it's also a question of how much the rise in US unemployment has been caused by the rise in immigration. It's possible both the SARM rule and the McKelvey rules will give false signals of recession because there's been an increase in labor supply through immigration. If employment remains strong but unchanged, then rising labor supply would mean an increase in unemployment but no fall in output, i.e. no recession. Where there are problems continuing is office delinquencies, and the black line is the delinquency rate on commercial mortgage-backed securities, and it is rising for offices, in fact, for most categories, but the rise in offices is particularly pronounced and showing no sign of slowing down. March sales to wholesalers were very disappointing at minus 1.3% month on month. And there was also a fall in wholesalers' inventories. So wholesalers not feeling confident about the future. The supply chain index fell in April, indicating more slack in the system. And the Conference Board Employment Trends Index continues to fall. Now, that is still a strong number by historic standards, but fading. And small businesses, this is an optimism index. That's a terrible number, actually. They are feeling at the most pessimistic they have been since, is that 2012? 2013? And the lowest this cycle. The fiscal impulse has turned negative in the US, despite the US running an enormous fiscal deficit. In order for the fiscal impulse to be positive, the deficit would have to keep on increasing, and it ain't. It's still at ludicrously high levels. Reminder that Biden is proposing the 2025 budget to raise taxes, including corporate taxes, to get the fiscal deficit under control. He's behind in the polls, so who knows what will happen. Liquidity is flat, and reported earlier used car prices were falling and new car sales were flat. Well, the loan rate for cars is very high, and that makes durable goods such as cars very expensive. So in some way, there are lots of indications that the US economy, particularly the jobs market, is slowing, but there's no sign of slowdown in either the Atlanta Fed's GDP Now forecast or the Johnson Redbook retail sales. Onto soft landing watch. Well, construction spending in the US has slowed, but when you look at it, that is still a really strong number. And reminder, the way a recession normally works is that you see a drop in both construction and manufacturing. Those sectors lose jobs, and that leads to cascading job losses through the economy and a recession. Right now, there's none of that. Manufacturing appears to be actually bottoming, and construction spending has been strong throughout. It's weakening, but from a very high level. And the latest jobs data shows that the construction sector continues to add jobs. So very little sign of recession in the US. And global trade shows signs of bottoming. So the global economy is doing okay. And credit card spending, having fallen in March, bounced back strongly in April. So very little sign of a slowdown in household spending in the US. Bottom line, US economy looks pretty strong with very little sign in the spending data that it's slowing. Onto other charts. Well, this is the fiscal balance of developed nations pre and post-pandemic. So the grey bars 2018, the dark blue lines at 2023, and you'll see there has been a general deterioration in government fiscal balances around the world. China, particularly bad. In the coming years, governments are going to need to tighten their belts. So this is British people's views of Brexit, and now over 60% of people think it was the wrong thing to do. It's a bit late for that. I think there's no prospect of us joining the EU again in my lifetime. And when we look at CO2 emissions over the last 20 years, well, US, Germany, UK, Japan have all cut our CO2 emissions slightly, but look at China, just absolutely shockingly enormous. So whatever we do has absolutely no effect. Now, turning to the coffee market, this is Chinese coffee consumption. There's gone from almost nothing 20 years ago, actually 15 years ago, to 5 million 60-kilo bags this year. So there's been a huge demand shock in the coffee market. And in the past year, we've had poor growing conditions in Vietnam, which produces a lot of cheap Robusta coffee. And that's led to a huge spike in the price. Now, looking into this, it seems that poor prices in previous years have led Vietnamese coffee producers to replace coffee plants with more lucrative other crops, such as durian, apparently. That may now change. Good news. And after that, you need some good news. So this is Opal. She was born deaf, but now, thanks to gene therapy, she can hear. And this is both amazing and pretty frightening. So what scientists did was they created a virus that contained a modified sequence of Opal's DNA that was designed to correct the genetic mutation which was causing her deafness. So the genetic mutation she had caused damaged hair cells in the cochlea. They then injected this modified virus into her cochlea and infected the cells within her ear and replaced the malign DNA with the correct modified DNA. And it appears to have worked. Opal can now hear as well as a normal child. So viruses can modify your DNA for better or for worse. Is that a good story or a bad story? Well, in this case, it's obviously a very good story, but worrying. And on to equities. Well, equities had another really good week on the back of falling interest rate expectations. The global market is up 2.4% on the week, up 7.3% year to date, approaching its highs for the year. The all share was particularly strong, up 3%, and is now actually doing well on the year, up 8.2%. Amazing. Euro stocks up 2.8%, up 8% on the year, very good. S&P 500 approaching its highs again, up 3% on the week, up 9.3% year to date. Its performance since the lows in October last year is extraordinary, up 20%. NASDAQ Composite up 3.2% on the week, approaching its highs. Russell 2000 back firmly above the 2000 level. Can it hold it? Hang Seng off to the races, up another 2.7%, up 11.2% year to date. Topics flat, still up 15% year to date. Bitcoin bounced, up 5.8% on the week, up 48.5% year to date. Sterling, despite the strong GDP numbers, down 0.2% on the week. Euro up on the week, but down on the year. Dollar index actually faded 0.4% on the week on the back of falling interest rate expectations. VIX dead as a dodo. Rising equity markets mean no volatility. Some charts relating to equities. Well, earnings forecasts are rising again. The line at the bottom is 2024 forecasts, and the top line is 2025 forecast. You'll notice there is over a 10% expected increase in earnings per share in the US in the coming year. So markets expecting strong earnings growth in the coming year. That will be difficult to achieve if the US economy does slow. Here you see that there's been a big divergence between the performance of US small companies and large companies. Since the US started raising interest rates, the margins of large companies have held up very well. Mid caps have fallen slightly. Margins of small caps have collapsed. The majority of job creation in the US is by small companies, and that is what is causing the slowdown in job creation. And if you look at the effective interest rate paid by companies, the strong US dollar and rising US interest rates has caused a big rise in the interest expense of emerging market companies. When the cycle turns, emerging market equities could well be the prime beneficiary. So Apple keeps on announcing enormous share buybacks, and the blue line is the number of shares outstanding. And you can see this is why its share price has done so well. Last year, its revenues actually fell by 4.3%. But as long as it keeps on buying back shares, share price can keep on rising. With 80% of S&P 500 companies reported year-on-year earnings growth in the year to Q1 was 5%. Not great, but positive. And the S&P 500 is expensive by historic standards. An operating PE ratio of 24.3, well above its mean, despite high interest rates. And in the coming quarters, the earnings growth of the Magnificent Seven is expected to start declining quite quickly, actually. But the earnings growth of the other 493 companies in the S&P 500 is expected to increase. And when we look at global earnings expectations by sector, technology, telecoms, the market's expecting solid earnings growth for everyone apart from energy. And in 2025, more earnings growth. Long term, you want to hold equities. It outperforms everything else in nominal terms with income reinvested. This is a log chart. On a linear scale, equities would have outperformed bonds by, is that 100-fold over the last 100 years? Big numbers. But everyone is very long. And this is retail purchases of leveraged equity ETFs. So retail is not just long equities, it is geared long equities. That is always a worrying sign. And on to commodities. Well, it was generally a very strong week for commodities on the back of falling interest rate expectations and optimism about the world economy. So oil rose slightly as Israel threatened to invade Rafah, and gas prices rose even in Europe despite high storage levels. We will go through that. Industrial metals were generally strong, as were precious metals. So looking at energy, Brent was up 0.7% on the week, up 9% year to date, as was WTI, up 1%, up 11% year to date. So having seen an inventory build last week, we now saw an inventory draw in the US. So the US oil market was undersupplied that last week, and that helped to support the oil price. US crude production was unchanged at 13.1 million barrels, and the Baker Hughes rig count fell by 7 to 499, which is a big drop. Now, this is global gasoline demand, and you see that it is slowing. The growth rate is slowing. There is still growth, but it's slowing. Now, turning to natural gas, it's been rising again despite storage levels being very high by historic standards. So let me read this out. European natural gas futures are trading above 30 euros per megawatt hour, a 33% increase from February levels, as concerns mount over rebuilding fuel inventories for the coming winter. Strong competition with Asia for liquefied natural gas cargoes has traders on edge, with LNG send out in April decreasing due to Asia's more lucrative spot cargo prices. Worries also persist regarding Russian gas flows through Ukraine, as a key 5-year agreement governing the transit of Russian gas through neighboring countries expires at the end of 2024. So, the fall in European gas prices means that Asian gas prices are now stronger, and Asia is paying up and getting LNG supplies. So it looks very much like European LNG prices have bottomed for now. And UK natural gas prices also rose 3.5% on the week, though they are down on the year, but that is not good news in the fight against inflation. Natural gas prices rising again. US natural gas prices rose 15% on the week and very much appear to have bottomed. They're still down 7.6% year to date, but I've read commentary that the very low gas prices is incentivizing power producers to switch to natural gas and gas producers to cut supply. So commentary I've read is that the surplus US natural gas will be eliminated by the year end, which means US natural gas prices are rising. And this is production. Now, part of this is due to pipeline maintenance, but you can see lower prices are disincentivizing production. That is falling production after years of growth. Coal prices fell back slightly, down 1% year to date. Uranium ticking up again. The bull market is back on. Onto industrial metals. So aluminium ticked back up 8% year to date. Cobalt going nowhere, down 4.5%. Copper, great week, up 20% year to date. Dr. Copper is diagnosing a strengthening and strong world economy. Chromium going nowhere. Iron ore going nowhere, down 18% year to date. Lithium going nowhere. Neodymium going nowhere. Nickel ticking up. Tin, another strong week. Looks like tin is back in a bull market, and strong semiconductor and electronics demand will lead to a rising tin price. Ferrovanadium actually showed a sign of life. So it's now up 0.4% on the year and has ticked up for the first time in a month. Zinc, bull market in zinc, up 1.4% on the week, up 10% year to date. Onto precious metals, falling interest rate expectations led to a 2.9% rise in the gold price, up 15% year to date. And that's all down to China. China has been buying a lot of gold, although its purchases have been fading recently. So the green bars are monthly purchases, and you'll see they've been buying less and less. Silver had an amazing week, up almost 9%, up 18% year to date. Platinum actually joined in, amazing, up 3.5%, which means it's up on the year. Rhodium going nowhere. Palladium, good week, but still down 20% on the year. And onto rates. Well, good news, finally. The UK yield curve has shifted down. I mean, still very high. So market is expecting UK interest rates over the next 6 years to stabilize around 4%. I think that's too high. But, and I've been wrong. The US base rates, also the US yield curve has also shifted down and is now well below where it was 6 months ago. It's down on the month. That's good news. Now, if you use the current US interest rates and compare them to core CPI, well, they're not really very restrictive. If you think that R star, the natural rate of interest, is around 1.5%, well, deflated interest rates are at 1.7%. So they're barely contractionary at all. No wonder it's taking a long time for the US economy to slow. Real yields are rising, so that means yield demanded to hold treasuries above expected inflation is rising. Is that a function of concerns over US debt sustainability? And the bad news for me is that real yields in the US seem to dictate what real yields in the UK are. So although UK inflation is falling, UK real yields are not falling as much as I would have hoped. And Callum Thomas is forecasting that inflationary pressures, long-term inflation is rising again, and that means real yields. And that means US Treasury yields should also rise in the coming years. I hope he's wrong. Bear in mind, nobody's very good at forecasting inflation, frankly. So this is the UK 2-year. Market now expecting UK interest rates to average about 4.25% over the next 2 years. We know that the term premium is about 0 or negative, so that is the case. 10-year, 4.1%, down quite strongly over the past week, but still well up on the year. 30-year, 4.7%. That is a big number and super bad for me. This is the US 10-year, ticked down over the past month, but still very high. German bond yield also coming off. Italian, Greek, going nowhere. Concluding comments. Well, the Bank of England lowered its inflation forecast and stated that it may begin cutting rates in the summer as long as disinflation continues. The UK economy saw strong and broad economic growth in Q1, driven by trade. And the US non-farm payrolls came in soft. US labor market is slowing, but there's no indication that the US economy is slowing as yet. Bottom line, we appear to be in a Goldilocks economy despite very high interest rates. And finally, on to me. Well, I had a better week, but still super bad. Now, I bought some more gilts this week, selling short-term gilts on which I made a minuscule return and buying some T58. Bottom line is you get a real yield of 1.2%. Implied inflation is 3.3, which I think is too high. So, as long, for the first time in many years, you can now get real tax-free returns on UK government bonds. And going forward, the Labour government is going to come in. I think they'll raise rates. So tax-free income is very welcome. That all said, I've got this totally wrong. UK inflation is actually approaching the 2% target, but I expected bond yields to fall sharply as inflation came down, and therefore bond prices to rise sharply. They don't need to go anywhere near their pre-pandemic levels for me to come out of this trade okay. The bottom line is they haven't done that. Yields have remained surprisingly high. I still expect, as inflation comes down further and the Bank of England to start cutting rates, that I should do okay. But I've been totally wrong. The high interest rates have not caused a US recession. They've not caused a global recession or deep global recession, and global economy appears to be bottoming. The equity markets are off to the races currently, and it seems as though the global economy is turning, which would mean I should bite the bullet and start buying equities. But the flip side of that is that equities have had an amazingly strong run over the last month, and I really don't like buying in when the run has been so strong. Valuations are stretched, and the US economy is slowing. So I am wondering what to do, is the bottom line. And if equities, there's a pullback in equities, I will consider buying some commodity equities, particularly copper. Richard has been way ahead of me on this, and his patience has been rewarded. Now, rather than continue to talk about my disastrous portfolio, which is very depressing, and I hope you are all doing much better than me, it's not difficult, let's talk about angel investments. So years ago, both Richard and I started doing angel investment, investing directly in small companies in the UK, primarily for the tax relief. So these are startups, and for the first 250 grand that goes into a new company, you can claim SEIS tax relief. So that's Seed Enterprise Investment Scheme, and this is extraordinarily generous. So you can, if you put in £100, £50 comes off your income tax if you're a higher rate taxpayer. There's no capital gains to pay if the investment is successful. If it goes belly up, you can claim loss relief. You can also pass the investment on as part of your will in the case of your death and will pay no inheritance tax. And if your investment in the SEIS scheme is made via capital gains, existing capital gains, then you get 50% tax relief on those gains. So seed in enterprise investment scheme, very lucrative, well, very generous for investments in very early startups, which of course are incredibly risky. If you invest in already established small companies, so this is the next, I think, 5 million, then the enterprise investment scheme applies, and that means you get 30% income tax relief. So if you put in £100, 30%, 30p comes, if you invest £100, £30 comes off your tax. There's no capital gains to pay on your, if it's profitable, you can offset losses against income tax, and again, you can pass it on to your dependents in the case of your death, tax-free. So that all said, Richard and I started doing this 8 years ago in 2016. That's how we met. And over the years, I have done 13 investments, and that's about 7% of my portfolio. And I have pretty much stopped doing it. Now, the tax relief is incredibly good. I have a few winners, none of which have yet been taken over and paid out. Now, in order to get paid out from an angel investment, it basically needs to be sold. The company needs to be sold. And people may tell you that the average life of a company is 5 years. Well, it ain't. It's, in my case, it is 8 years and rising. And we have several profitable and successful companies in the portfolio, none of which have yet been sold. So I've had two failures, one of which was 100% loss, one on which I got part of my money back, and I did did an angel investment podcast on this. I will at some stage do a podcast on the other one. In fact, I may get around to that this weekend. Now, within the portfolio, I now have 2 companies that are in the process of selling themselves. In both cases, this is not because they're doing terribly well. It's because they're running out of money. The technology is developed and they need to find an acquirer to keep going. So I call these defensive sales. We will see, and I will report back on whether I actually get my money back in both cases. But the reason I've given up investing in angels is that first of all, I think there's a big selection bias. So you go to these meetings, which are hosted by a broker, and you see lots of pitch events. The reality is, you go to a few of these, they take up the whole of your evening. You may see 4 or 5 pitches. Of those, you may invest in, let's say, 1 in 10. It takes up a lot of your time. Professional companies see hundreds and they invest in 1 or 2. There's a huge selection problem in doing this on your own. I came to the conclusion, particularly in the case of SEIS investments, that it was better to outsource it to a professional company, and I've done that via Q Ventures. They will take 20% of any gains, and bear in mind, you bear the losses, 100% of the losses when it goes wrong. So paying 20% out in the winners means that your net fee is going to be much higher than 20%, assuming you have some winners and some losers. But primarily, it's because I've become incredibly frustrated with my existing investments because they don't provide you with any information, even when they're contractually obliged to. One of the companies that is now going through a sale process, Richard and I invested literally when it was a drawing on the drawing board, and we funded the writing of the original code at a valuation of 750k. So we put in between us as a syndicate 150k at a pre-money valuation of 750k. The software was written. We then had a good relationship with the CEO. Over the years, though, the CEO made it very clear that he didn't want to have any further interaction with us. The monthly updates failed to occur. They became quarterly updates, and the quarterly updates were frankly the least informative I've ever seen. They used to make my blood boil because they really were contemptuous of investors. They contained statements such as revenue, green tick. So that didn't tell you anything at all. I thought they were contemptuous of investors. The venture capital came in and joined the board. They promised to have an annual recurring revenue by the end of last year of £1 million a year. I've yet to see the numbers. All I know is it's well off track, and hence they're putting the company up for sale. And frankly, when you invest in these things, you want to have some sort of relationship with them. You invest in them to get involved. Now, in the startup that Richard is working with, where he's the CFO, that looks like it's a great success. And if that is sold in the next 5 years, then I will have made a very good return on my angel investments. But so far, it's not going terribly well. I mean, we will see how these two defensive sales work out. I'm on the board of one of them, and I'm very much involved in the sales process, which is really interesting. And it is not at all clear that I will get out at par, but you never know. So I'll report back on how that goes. The bottom line for me is that the one with Richard is interesting. I'm involved on the board, and that's a great success. How much of that was down to us? And almost nothing. We chose a good CEO who tilted during the pandemic into payment systems, and that's going really well. If he hadn't done that, then that company would not be doing very well either. So the bottom line is that I'm just not getting enough information out of them, and I don't feel involved. And it's very difficult to you take a lot of risk. And also, I'm getting older. When it's like going to take you 8 to 10 years on a new investment before you see any result, and in the meantime, the journey is not much fun, why bother? So my advice on angel investing is only do it if you have a good relationship with the company, or you're willing to just fire and forget and have no relationship with them for 8 years. Now, next week, Richard should hopefully be back. His boat will have been back in the water, and that'll be more fun. And I will be doing a long piece on the causes of the current inflation. Thank you to Mr. C. Peckham for all his hard work and getting in touch. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.